Hello, and welcome to another Bond Buyer podcast. I'm John Hallacy, your host today. And with me are two folks from the Kroll Bond Rating Agency. Jim Nadler, who is the CEO of Kroll, and William Cox, who's a managing director in their research area. Thank you, gentlemen, for joining me today.
Thank you, John.
Thanks. It's great to be here.
Well, there's a lot of activity in the markets right now, a lot of volatility going on. The yield curve is getting flatter in treasuries, a little steeper in munis. So we have a lot going on, but I wanted to talk a little bit about Kroll and where you're positioning yourselves in the market and what do you think the future holds. But first, I would just go back to, it's been a few years since Kroll has been relaunched, so to speak. And we know that the firm is doing quite well on the structured side of the business for a lot of reasons post-2008. And just wondered if, with the recent volatility in the markets, do you think it's reasonable to say that this time is different for structured finance?
It's always different. You know, I will say a few things about the structured finance market. First, the Dodd-Frank legislation, I think, there are parts of Dodd-Frank that I certainly will quibble with, but I think there were parts of Dodd-Frank that did do a service for the market. I think the residential mortgage market is in better shape because of that. There are people would argue, and they're not wrong, that the pendulum may have swung a little too far. It's harder for 30-somethings to buy their first house today than it was when I was in my late 20s, early 30s. And I think that eventually we'll get that sorted out. But I do think it has structurally made the market stronger. I also think that the requirement that rating agencies and investment banks be more transparent, particularly rating agencies around criteria, more transparent with the buyers of the securities. That's also created a different structure on the buy side. I think the crisis created a different structure on the buy side. I think many more investors now do more of their own work, and so they spend more time looking at research, and it's why our research is as much a part of the product that we provide to investors as the rating today. And all that's been a positive. And so I think for those reasons, I do think the structured market is stronger. And I actually think it's made the entire fixed income market stronger.
Okay, very good. I know that CLOs have picked up recently. I don't know it from direct experience, but I've been reading how it's really accelerated again. And there's a lot to consider there. Well, segueing back to munis, I was just curious about what you think goes through the issuer's mind when they say, I want a Kroll rating on this one. Maybe I don't want to go with the other guys, or I just want to go with one of them, not all of them. But I think I want Kroll in the mix. How do you differentiate yourself, and how do you entice them to come to Kroll?
I'll let Bill give you more details, but I will tell you it is our research, plain and simple. Our analysts have an average of 25 years of experience, and when you compare our research reports against our competitors, we inevitably are the choice for investors. And it's why a number of AAA issuers, so issuers that have AAAs and ratings from other rating agencies, have asked for our rating. It's because of the research report.
Yeah, that's right, and experience matters. So we tend to get engaged on larger, more complex transactions because our analysts have more experience. And as the market goes through certain changes, issuers are increasingly coming to us because they know our analysts have seen the cycles and they've seen these changes before.
Do you feel like they're giving you, or you're giving them, a fresh look sometimes?
I do. I think that if you look at what's happening at Moody's and S&P, and even Fitch to some extent, they have, post-crisis, they have turned their criteria into more of a formulaic approach. Where
Matrix scorecard.
Matrix
whatever.
scorecards. There's less emphasis on good old-fashioned credit work and on an analysis of the management, the budget process. And listen, we deal with a lot of smart investors. They can look at the numbers themselves. They don't need me to tell them that a 5 times leverage is a sort of triple B-ish risk. What they're looking for is for us to tell them what the management was like, what the budget process looks like. And it's why, I'll give you a great anecdote. I was waiting outside, this is some years back, I was waiting outside of the Treasurer Napier in Connecticut to meet with her, and we had just started rating the state of Connecticut. And their short-term bankers were in meeting with her before me, and they all 3 came out. It was, Webster Bank, B of A, I forget who the other one was. And they all 3 had our report dog-eared with stickies in it to ask questions. Now, Moody's and S&P have been rating Connecticut for almost 100 years, and it was our report that they were looking at to ask the treasurer questions. So I think that speaks to the depth and breadth of the research that they get from KBRA.
Okay. Well, we talked about the reports a little bit, but I just wanted to focus a little more narrowly that you seem to be differentiating yourself also on the criteria front. A couple of things have come to mind of late. Bill's been involved in some of them, but the approach to pension funding and the rating ceilings are 2 areas that I think just off the top. And I guess I was interested in your take on those, but more importantly, should we expect more reappraisals of criteria principles going forward?
No. We may change ratings because of fundamental credit factors, but we don't change our minds. And I think what you've seen recently is a change in mindset from others. So I think to the extent that we are different, we're different because of fundamental credit reasons. So in the case of pensions, as you and I have talked about before, John, we're trying to distinguish between public policy and credit risk. And you may not like the public policy decisions that legislators make on pension issues, but those decisions don't always translate into increased credit risk, as an example.
Okay.
Well, I also think this, Bill, and I'd be interested, I know you have an opinion on this as well, and John, I know you've been in the industry a long time. No one, investors, issuers, public policy, people who write about public policy have any interest in this manufactured crisis that happens at S&P periodically. And this latest one is just another example. There was no change in credit risk, and if you read the report that they put out, there was no cogent explanation for why they were changing the rating. They simply changed their minds. And I think that investors are very wary of these multi-notch downgrades, particularly when they're caused by manufactured crises like these. And I think in the long run, it's going to hurt S&P's reputation.
Well, I just to speak from memory here, I do recollect being on the trading floor when a multi-notch downgrade came through. And that's one of the few things that rocks the traders and salespeople. They do really take notice of that. And part of the problem is they have to reprice right away, and they're not sure what they should be doing.
Where's the floor?
Yeah, they really have to think about it.
Yeah, and it's one thing for it to be credit issues that you may have gotten behind on, which is unforgivable.
Right.
But it's another thing completely for it to be about you've changed your mind about how you're approaching broad swaths of the market. This criteria change may affect hundreds of billions of dollars in the municipal market.
Well, in fairness, I mean, I think it's okay for a rating agency to refine their criteria and change it up a little bit, but they have to be sensitive to timing and all those things as well.
Not only timing, I think they have to give
and the rationale. And again,
I think
has to be solid.
It has to have a cogent rationale. And I think that that's really the issue. If you have a rationale for the way you view something, that you've really thought through, there's rarely something that you rarely just change your mind because you've rethought it. Generally, it's because something happened. And so in order for the change to be accepted by the market broadly, they have to understand, okay, this change happened, you changed your mind, I got it. And that simply was, and we've talked to a number of investors who felt the same way. There wasn't a real, an example that they could really follow, and therefore they felt as if this was just a capricious sort of change of the mind. And so,
well, I asked if it had anything to do with COFINA, and I certainly don't want to drill down into Puerto Rico right now all that much, but I got the answer that it was, maybe that was in the mix, but it wasn't the primary driver.
Yeah, and I think you got the messy answer that everyone got, and I think it sort of frustrated market participants, because when you're having to explain to the head of credit why you've had 4 bonds downgraded multiple notches, and there's not a cogent reason, I think it puts investors in a very difficult spot. And so these are the kind of things that the market just shouldn't have to tolerate.
So we don't expect any multi-notch downgrades from your shop?
No.
Okay. Just clarify.
Just clarify.
And if we do, I won't be sitting here next time.
Wanted to talk a little bit about the business aspects of a rating agency. I mean, you provide reports for free to many participants in the market. And I'm just curious why that approach, and would that policy ever be revisited down the line, do you think?
We feel very strongly about a portion of our research being free. There are a number of, there are probably 40 investors who can afford to have armies of analysts looking at everything, but there are another 2,000 that really can't afford to spend a lot of money on research, and it's those investors that we try to make sure that we have our information available. And for the most part, we don't expect to change that policy. We do have services that we provide that we charge investors for. And we will continue to grow those services. We have one in the commercial mortgage-backed area that's a surveillance product that looks at every commercial mortgage-backed security in the market on a monthly basis. And we charge investors an annual fee for that. We have a couple of other products that we're going to be rolling out over the next 6 months that are going to be the same, that are detailed analysis that we will charge investors for. But there is a portion of our research that we believe should always be available to the investing public, and so you won't see us changing our mind about that.
Okay. I'm sure a lot of muni investors would love to see something monthly, but just about the only sector we get some of that information is in healthcare.
Right.
I don't know if it'll change down the road.
Well, we certainly try to do more research. We are looking at ways that we can provide more information to investors, things like market implied ratings and other ways to sort of have a check and balance on the rating process. And it really, our goal is, in addition to doing the credit work for rating and rating issues for investors, our goal is also to engage with investors. We spend a lot of time talking to investors, and so we try to do thoughtful research pieces that ignite conversation and cause us to have conversations with investors. We learn a lot from those conversations. I think it makes us better as a rating agency, and investors have told us they love those conversations because they get more and a different perspective when they talk to us about them.
I do remember working on P3s, and getting a rating indication beforehand was really important. Are you finding more of that activity?
We do.
Yeah, in fact, a lot more of it. So we're doing a lot of work in the P3 area in collaboration with our project finance group. But even in the municipal market, there have been a lot of large, interesting transactions that are off the beaten path a bit. And we tend to go through an indicative rating process with them before they publish the rating.
Yeah, well, as you know, it's so difficult bidding on a P3 package because you have to be fairly certain about most of the moving parts. And I'm sure they value that service.
Yeah, we released a rating on Michigan's I-75 project yesterday.
Oh, you did?
Yeah,
Okay.
through our project finance group, working with our public finance group. It's a great credit, very interesting.
Availability payments, right?
Yep.
Yeah, okay. Again, just sticking a little bit with the business theme. Volume is down in municipals 14.3% year to date. And by year end, we might be still down pretty substantially from last year. Is this a troubling development for your shop? Does it change your business plan at all?
No, and I mean, we have been in the muni market since 2012. We've grown at 80% a year, but we're still, compared to Moody's and S&P, small. We have a small market share, so we've got a lot of there's a lot of market share for us to catch up on before the size of the market really impacts what we're looking at. We are more sensitive to the larger, more complex issues, as Bill said. I think the average muni deal is what, Bill, you did the math.
Yeah. In the market this year, the average deal size in the market is about $37 million. That sounds about right. Our average rated deal size is about $383 million. So that gives you a sense that the deals that we're looking at tend to be 10 times the average market size deal. And the same last year was a little bit higher. But the good thing about having started recently is that every year, despite the market being down overall, our market share is growing. We're approaching 10% of the total volume.
Okay, well, it's always a long runway, right?
It's always a long runway.
Jim, you did mention Dodd-Frank, and of course there's been a lot of retrospective looking at Dodd-Frank, and certainly the whole rating agency view in Dodd-Frank was kind of a big change at the time. But now people are saying, well, maybe it's a little too restrictive or whatever. Do you see any relief on the way there?
We spend, Kate Kennedy, our head of investor relations and governmental outreach, and I spend a lot of time in Washington. In fact, we just got back. We were there Monday and Tuesday this week. We spend a lot of times with House members and senators who are on the House Financial Services Committee and the Senate Banking Committee, talking about Dodd-Frank and talking about the things that have been really positive about Dodd-Frank, and the things that have been, that we sort of find are maybe a bit restrictive. I think all in all, Dodd-Frank has been good for the rating agency business in that it did a couple of things that I think were very important. And it's almost surprising that the rating agencies didn't do this on their own. One is separating commercial activities from analytic activities. So no longer does an analyst have anything to do with bringing a deal in, deciding what the fee is, or anything like that. And that's had a big impact on the analytical process, particularly at our shop. I've noticed it. I've been pleasantly surprised by the number of analysts who, at the end of the year, will really tout the number of reports they put out, the number of investors they've engaged with, and that's really what it should be about. I'll tell you one funny story. When Dodd-Frank was first enacted, they had a rule that you can't get more than 10% of your revenue from one client. And if you do, you run afoul of the rule. So of course, when we were just starting out,
so a little
first few years, but yet Moody's and S&P, it didn't affect at all. So we were, completely used to rail against the rule. Now that we are much larger, we don't have that problem, so we're a big proponent of the rule.
Okay. Let someone else do it.
Exactly. We like when we get up in the treehouse, we like pulling the rope up.
When you join the club, that's it. Okay, moving right along. Tax reform in a lot of respects has been the greatest change in municipals, without advance refunding and lower rates and all the rest of it. but it hasn't led to any real deleterious effect on the market. And I'm wondering, and I know this is not a rating question per se, it's more a business question. Is there any reason to expect that this will change next year? I think people are going to be taking a harder look after they file their 1040s and figure out what that big property tax bill might mean next year. How are you viewing that and sort of incorporating it into what you do?
Well, I think from the and I'll let Bill talk about the effect that it may have on muni issuance and muni issuers, but I think from a from a consumer standpoint, I do think you're right. I think when people do their taxes this year, I think there is going to be some thinking about this and how, did I put enough aside? Do we need to hold, is it costing us more? And then that's going to take money out of consumers' pockets, which could impact consumer spending. I think the offset to that is going to be there's how much you can deduct, but then there's the AMT cap, and most of the people who are subject to that deduction are also subject to the AMT cap.
Yep.
So it's not one for one. And so I think
I wasn't suggesting that.
No, I know you weren't, but
mm-hmm.
I agree. I'm agreeing with you in that I do think we're going to have to wait and see.
Yeah.
I think we're going to wait and see if there is going to be an impact on consumer spending and how big that is.
Yeah.
I know you had some thoughts on municipalities
we know that there are going to be communities, and I don't think even the communities themselves know it, where that household that's not quite at the AMT cap that loses the property tax deduction, and they're caught in the middle, so middle higher income. And where those communities are and they lose that deduction, that next year's bond referendum for the schools may hit a roadblock. And I think you'll see some pressure build up in those communities with regard to their local bond ordinances, their budgets, but where they are, I think, is still something that will take some time to figure out.
Well, next week we have, I think, over $80 billion on the ballot, state and local. So we'll get some gauge there.
It will be an interesting week for a lot of reasons, I would think.
Yeah, but that's a good point about AMT. I mean, there's so many things in the tax bill you can point to, like taxing endowments. I mean, and et cetera, et cetera. So. Right. I guess I'm just feeling like we haven't felt the true impact yet.
No, I think you're on the exact right topic. I think that we're going to know when they do actually pay their tax bill next year. I think that's when we're going to see the real impact, because I don't think people know right now. I think that's right.
Even if the accountants have penciled it out a little bit, it's not real until it's real. So. Again, just pulling back and going a little bigger picture, macro and global forces influence municipals more than they have in the past in a lot of respects. Are there any takeaways from the other lines of business? I was kind of thinking sovereigns and some of the other, global type activity you're engaged in.
No, I think that yes, I think that people are keeping their eye on. There's been a large risk transfer from commercial banks to investors in the corporate space. So you see the double B, triple B sort of corporate bond issuance and leverage loan issuance. And that used to be on the balance sheets of banks, and today it's not. And today it's on the balance sheet of investors. And it's more spread out than it was years ago, so it's not concentrated in the banking system.
A lot less risk for the banks.
A lot less risk for the banks. The banks are in better shape, so less risk that there'll be a contagion and we'll see a systemic issue. But I don't think we know when, and certainly we know that cycles happen, and so when there is a downturn, and it does impact that sector probably disproportionately, I don't think we know how it's going to react. Is there enough liquidity in the system to absorb the dislocation, absorb it quickly, or does it take a while? And so I do think that that's one of the areas that we certainly are keeping our eye on. And whenever we talk to investors, we hear the same thing. that's where, if I was going to point to an area where people think there might be a bubble, it's really that area.
Well, as you know from experience, in the downturn, people care about liquidity. And I'm hearing now that high yield maybe some of the patina is wearing off high yield a little bit. Are you finding that?
I think that's right. I think that's what investors are worried about.
Yeah, especially heading into what may be hopefully a soft landing or a recession in the next couple of years. I think in the municipal market there's been a lot of investing in real estate oriented bonds and senior living type bonds that may come under some pressure. I think another topic that's global that's beginning to impact the municipal market is we all know that European investors and regulators have been ahead of the curve on ESG issues and environment, climate issues.
Yeah, good point.
And that's seeping into the municipal market. I think everyone's running around trying to figure out how to score it, how to evaluate it. And I think right now it's about how do you get into the mind of a European investor that wants to bring money into this market. Over time, we're focused on the specific issues that may impact credit. So stay tuned. We'll be doing some things sometime next year about how climate issues specifically impact specific communities.
Oh, no question. I mean, I think those of us who've been in munis a long time, we feel, hey, aren't all munis green bonds?
Exactly, exactly.
Without the certification, but I understand that the certification is important.
No, but John, I think you hit on a good point. I mean, I think there have been a number of issues, simply because you call it something trendy doesn't mean we haven't been doing at least some of that for a while. And I agree with you. I think we look back and we do see a number of things that we've done in the alternative energy space, wind bonds, PACE bond, and in the muni space
the
that
water,
exactly
sewer treatment,
have
et cetera,
always been green bonds. And so we're trying to find out what we already do that is, effectively comes under the green bond category. And then what we can do better, what kind of research we can do, the type of and trying to be a model citizens ourselves. We try to think about our carbon footprint and what we're doing with respect to things like how we think about our waste product, on a daily basis at Kroll. And also we think about, on the social side of it, we think about our social responsibility and where, when and how we engage our workforce to get involved in social activities outside of outside of our business, whether it's giving to things. We have a number of charities that we give to, but also helping, going to Ronald McDonald House and serving lunch occasionally. So we are rethinking, the entire area. But I love your point because I think it's not something that just happened, last year, ESG. Yep. It's been going on in munis for years and years and years, and being able to tell that story, we think is going to be important as well.
No, I agree. Obviously, it's just a little different approach in Europe, but clearly it's been here for some time. Again, taking a little broader view, this is maybe a little more philosophical. What is the real role of a rating agency? Do you think the format will ever be changed away from the issuer paying for the assessment? I know, does it need to change? I mean, I think at the beginning, Kroll was trying to change the format.
He wanted to start an investor pay service.
Yeah. And I don't know if there's any more thinking at all about that, or is it reviewed periodically, or how does that work?
No, I have very strong feelings on it, and we can talk about them.
Sure.
First of all, the role of rating agencies. I think rating agencies serve a dual role, and that role is to facilitate commerce and protect investors. And they really have both of those roles. And so this idea that lower ratings are always better is nonsense. Mm-hmm. The right rating is the best rating, because we're in the business to protect investors, but also facilitate commerce. With respect to the issuer versus investor pay, I think a couple of things. I think first, both issuer pay and investor pay have conflicts. So the issuer pay has the obvious conflict, and we talk about it all the time.
Sure.
But investor pay, I had my own independent research company for a few years, and I had a number of investors approach me to write negative reports on companies that they had shorts on, and even when the company didn't deserve it. So there's always a conflict, no matter how you arrange your business. The issue is how you deal with those conflicts and what you do to set up boundaries so that you don't succumb to those conflicts. Lastly, the reason that I think the issuer pay model works the best for our capital markets in the U.S. and in Europe is because of the requirement of the regulators that ratings be freely available to everyone. If you have issuer paid ratings, you can imagine who would be paying for the ratings. It would be PIMCO, the PIMCOs, the BlackRocks of the world. And I can tell you, if they paid for those ratings, they're not going to share them with other people.
Yeah,
and so
investor pay.
You would have a concentration of investors that had, and what you would really do is you would exacerbate the asymmetry of information in the market and cause smaller investors to have even less information available to them.
Not the goal.
And exactly. Yeah. And so I've always believed that the issuer pay model served the mid-sized and small investor much better, and that what the crisis pointed out to us or uncovered was that the incumbent rating agencies weren't managing those conflicts very well. And I think Dodd-Frank has set up some ways that some transparency that you can tell how well the rating agencies are managing those conflicts. But I think it's a fair question for every investor to ask every time you sit down with a rating agency is, how are you managing those conflicts? We could talk for hours about how we manage those conflicts, and I think it's important that investors understand that.
And I'll add one thing to that, is that Jules and Jim had the ability to start from scratch as this new regulatory environment was unfolding. And having worked in another rating agency for many years, I can tell you that walking into the culture at Kroll, it's very different. We're not trying to convince people to behave a different way or trying to build systems on top of old processes. It's integrated and intertwined into the processes from scratch.
Okay, good to know. I mean, I know I read Dodd-Frank a long time ago, and basically I was forced to read it.
We all were.
And I think there was a provision in there that if the rating agencies couldn't figure it out, the government would take it over and assign ratings. Yeah. That was kind of a difficult idea as well.
Right. Well, I think, if you just step back a little bit, I mean, the rating agencies, for all their warts and the rating agency business, for every, the crisis was terrible, and we can talk ad nauseum about what that did to the confidence of investors, and I think there's enough blame to go around, but certainly the rating agencies were partially to blame. But if you look at the rating agencies' track record outside of that, the rating agencies have done a few things that have been really positive for the market. I think one, the rating agencies have really defined how we talk about credit in the fixed income market. You and I can talk about a AA issue, and we both generally know what that means.
Yeah, the shorthand is important.
It is, and so and that was the rating agencies. The rating agencies for years and years and years put bonds in those categories to the point that we all know now what that means, and that's become an integral part of the fixed income markets. I think that what we've tried to do at Kroll is take some of the best things that the rating agencies have done and add to it some more strenuous oversight, so that we don't get into the trouble that they got into in the mid-2000s.
Yeah, it was certainly a difficult period for all. Would you say the reliance on rating has changed at all, or is it about the same?
I think investors still have investment guidelines and they need ratings. I think that investors do more of their own research, and now I think we have a healthier dialogue with investors. And I think it's why I said early in the podcast that our research is really a big part of the product that we provide to investors. So it's both our research and our rating that they rely on.
I know that when you're evaluating a bond, people want to see an array of opinions.
Right.
And then figure out where they fall on the continuum.
Right.
Okay, great. Are there any topics that we've missed here? Or something else you wanted to add?
I think we covered the waterfront pretty well. I guess we could talk about the World Series, but it'd be a short conversation. I hate the Red Sox. I don't know. How do you feel?
I love the Phillies. Everything else doesn't matter.
Yeah. Well, New York wasn't in it. So,
I know. So what did it matter? Yeah. No, this has been great, John.
Well, Jim Nadler and Bill Cox, thanks for joining me today from Kroll Bond Rating Agency.
Thank you, John.
Thanks.
Thanks for listening to our show today.